All right, my friends, this was the Morningstar Best Fund for the first decade of this century. USAGX, the USAA Gold and Precious Metals Fund. The #1 fund, according to Morningstar, for the first decade of the century. Watch. You're going to be just mystified how well and badly this thing has done over the last 20 years. It's mind-boggling. Does that mean you should not hold a portion of this in your portfolio? I'm not saying that. I'm going to say this is what happens when it goes up and it goes down. It's nuts. So don't forget to subscribe down below. As always, thumbs up, comments, the whole thing is appreciated here at the Heritage Wealth Planning YouTube channel. So let's dive right into this. You may or may not recall back in the heyday of the gold funds, the gold bugs are everywhere. Really selling gold as a way to deal with the Ben Bernanke helicopter Ben inflation, the hyperinflation that's certain to come, and blah, blah, blah. And I still chuckle because, I mean, look, I fell for that. I didn't buy any gold back then. I didn't have any money to buy gold, but I fell for it for sure because I said, if they're going to inflate the currency like they're doing, there's nothing but hyperinflation is going to come. And we look at what's going on in Venezuela now, we realize that maybe the monetarist, the theories of Milton Friedman, look, I love Milton Friedman, but maybe that isn't quite as pure when it comes to pure inflationary policy. I mean, if you look at the Milton Friedman, the monetarist economics, they'll say, hey, that means if they're spending a lot of money, they're printing a lot of money, inflation is everywhere and everything a monetary problem. And I don't know that to be true. I mean, look at what's happening in the United States today. We've flooded the zone with lots and lots of dollars, and here we are, the 10-year treasury is about 2.5. It's amazing, actually. And that'd be a barometer of inflationary issues, and we just don't have it. It's nuts. Venezuela, on the other hand, they got tons of inflation because government policy is just dictated, to command and control. Anyway, let's not get into it. So, but that was a heyday. Everyone's like, oh, gold, we got to own gold because blah, 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 blah. Now, gold itself as a metal and gold as a mining stock, two completely different things. Here we're just going to use the mining stocks, the gold and precious metals, USAGX. Forgot the guy. I think the guy who was running this fund just retired. I forgot his name. Bonham, I thought, like the old drummer of Led Zeppelin, Bonham. Might be mistaken. But anyway, all right. So we start with the $100,000 in 2001. Well, let's just read you what these guys have done. All right. So this is we're taking 5% off a year. So in 2001 it was up 31%. 2002 is up 67%. 2003 is up 71%. So 30% on $100,000, we're able to take off $6,500 in cash money. The following year, up again, 67%. So we take 130,000 minus 648 times by 67%. Our ending value was 208. We're able to take 10,000 bucks off. The following year, 2003, is up 71%. So we take the ending value here, take this minus that, times by 71%, gives us that. We're able to take $16,981. 2004, we're down 10%, so we're still able to take 14,000. 2005, we're up 39. 2006, we're up 43. 2007, we're up 27. And even in 2008, when the stock market was getting hammered, we were only down 24.5. So at the end of 1, 2, 3, 4, 5, 6, 7, 8 years, we took $22,000 portfolio. We still had well over 4 times what we put in. 2009, a huge year. Yes, 62%. We're taking $34,000 off this guy. 2010, another huge year, 39.92%. We're taking $46,000. Almost, I mean, that's almost half of what the initial portfolio value was just 10 years previous. Crazy. But then we started getting hammered. We're down in 2011, down 19.52, 11.86, and then we're down 51.32%. So we're now taking what was 923, about a quarter of what we were. And I remember people who were investing in this in 2010 and 11, and they're putting their whole life savings in there. Man, I'll never get. I inherited a guy. I never talked to him. I didn't want to talk to him to save my life because I said, man, if that guy, he's gonna get mad at USA. I don't want anything to do with him. But anyway, I inherited him as a client, and I didn't talk to him. And he was dealing with this guy previous to me, and I don't know what the situation was, but the previous to me guy had left USA or moved us. I can't remember. But anyway. And I didn't want anything to do with this guy because he had like, I don't know, $2 million that he had moved into the gold and precious metals fund. I think it was worth like $300,000 by the time I inherited him. And I never talked to him because no way. I didn't want anything to do. That was a hot mess. That was a mess. And I said, I don't want anything to do with him. The guy didn't leave USAA. That's right. He emailed him and said, hey, this guy, whoever replaced you, hasn't called me. And that dude reached out to me. I said, no way, man. I'm not talking to that guy. I mean, that's it's the case. You had a pretty good relationship with him. You talked to him. I'm not taking that on to save my life. And lo and behold, I'm glad I didn't because I'm sure that guy's not a happy camper. No way. I mean, if you get $2 million, it's down like $300,000. Now, look, in 2015, so 2014 is down 8.27. 2015 is down 26%. So now we're sitting on $166,000. About 20% of what it was initially. We're still pulling $8,316 off. That's not too shabby. 2016, a pretty good year, is up. Yeah, real good year, is up 46%. But I mean, 46% on 166,000, while good, is not nearly what 62% was right here. I mean, you see what I'm saying? So, but we're still. So at the end of the day, the portfolio was worth $240,000. We still more than doubled our money. We took a total of income off $350,000. $350,000 off this portfolio. You know, so you start with $100,000, you got $240 to show for it, you took $350,000 off. I don't think anyone's gonna complain there, other than unless you start to put money in right there, which I hope you did not, because that's not good. You don't want to be messing with that. That's why you don't chase the winners. You cut your losses and ride your winners, but you don't chase the winners. All right, so stay tuned because now we're going to talk about the Vanguard, the real estate, the REIT fund. And then we're going to talk about the Vanguard high yield bond fund. And then we're going to give you a neat little tutorial. We're going to put a bunch of different funds together. And we're going to show you a couple different scenarios on how these all worked out combined, because I think that's where it's going to get exciting. What happens if we had the gold and precious metals fund as part of our portfolio? What happens if we have the REITs, real estate investment trust, as part of our portfolio? What happened if we had the Vanguard Wellington fund, or we had the high yield income fund as part of one big portfolio when 2001 to 2017 came around? Be interesting to see, so stay tuned. Don't forget to subscribe, and we'll see you next time. Thanks, guys.